Hello and welcome to our channel. Virtual currencies, including bitcoins, experience significant price volatility. Fluctuations in the value of the underlying virtual currency between the time you place a trade in a virtual currency futures contract and the time you attempt to liquidate it will affect the value of your futures contract, as well as the potential gains and losses associated with it. Investors need to be very careful and monitor any investments they make. So watch our video to the very end so you don't miss the most important things.
Bitcoin futures allow investors to access bitcoins without having to hold the underlying cryptocurrency. They are similar to a futures contract on a commodity or stock index in that they allow investors to speculate on the future price of the cryptocurrency. The Chicago Mercantile Exchange offers monthly contracts on a cash settled. This means that an investor takes cash instead of the physical delivery of bitcoins when they enter into a contract. The Chicago Board Option Exchange offered the first Bitcoin contract on December 10, 2017 and will stop offering new contracts in March 2193. CME opened a Bitcoin futures platform on December 18, 2017. In addition to futures, it now offers options on Bitcoin futures. Meanwhile, Bakkt and Intercontinental Exchange offer daily and monthly Bitcoin futures contracts for physical delivery.
Bitcoin futures serve many purposes, each unique to different participants in the Bitcoin ecosystem. For Bitcoin miners, Bitcoin futures are a price-fixing tool to ensure a return on their mining investment, regardless of the future price trajectory of the cryptocurrency.
Investors use Bitcoin futures to hedge their positions in the spot market. For example, if an investor bets on an increase in the price of Bitcoin in the spot market, she can short her futures as a hedge. That way, she can make money even if the price of Bitcoin moves in the opposite direction to that specified in her bet. Speculators and traders who frequently enter and exit futures trades can use Bitcoin futures for short-term and long-term profits. Trading Bitcoin's futures instead of the underlying cryptocurrency offers several advantages. First, Bitcoin futures contracts are traded on an exchange regulated by the Commodity Futures Trading Commission, which can give large institutional investors some confidence in participating. For most of its short existence, cryptocurrency was traded outside of regulation, making it a risky asset for institutional money. Second, because futures are settled in cash, a Bitcoin wallet is not required. There is no physical exchange of Bitcoins in the transaction. Thus, trading Bitcoin futures eliminates the risk of owning an unstable asset class with dramatic price changes. In addition, holding Bitcoins can be costly and add to overall costs. Finally, futures contracts have position and price limits that allow investors to reduce their exposure to these asset class.
The growth of the Bitcoin futures market has occurred in parallel with the growth of the cryptocurrency spot market. Cryptocurrency exchanges were the first venues to offer Bitcoin futures trading, but the lack of regulation for cryptocurrencies made them dangerous venues for serious traders.
The launch of Bitcoin futures trading on the CME and Cboe changed the status quo. While Cboe stopped trading Bitcoin's futures on its platform, CME doubled down on cryptocurrency and introduced other derivative products related to it. For example, a micro Bitcoin future is 1/10th size of a standard Bitcoin futures contract on the CME. Bakkt, which is backed by Intercontinental Exchange, the owner of the NYSE, was launched in 2019 and advertises itself as a comprehensive solution for promoting regulated prices and market liquidity. It also offers Bitcoin futures and options trading with the physical settlement. ErisX is a Chicago-based trading firm that offers limited cash-settled Bitcoin futures trading, which limits access to the cryptocurrency by setting upper and lower limits. Exchanges like Seychelles-based OKEX and Malta-based Binance are among the largest venues for trading in Bitcoin futures. The latter exchange, in fact, ranks first in terms of the number of open interest contracts on its platform. However, it is not regulated by US authorities.
The rules and settings for Bitcoin futures are the same as for regular futures trading. First, you need to create an account with a broker or exchange to begin trading. Once your account is approved, you can begin trading.
Futures trading makes extensive use of leverage to execute trades. In the unregulated Wild West of cryptocurrencies, the amount of leverage can vary greatly between exchanges. For example, Binance offered traders leverage of up to 125% of the trading amount when it first launched the ability to trade cryptocurrency futures. In July 2021, it lowered its leverage to 20%. The main considerations for Bitcoin futures accounts are margin requirements and contract details. Margin is the minimum collateral you must have in your account to make trades. The higher the amount of the trade, the higher the amount of margin required by the broker or exchange to execute the trade. It should be noted here that exchanges and brokerages may have different margin requirements. For example, the CME has basic margin requirements, while brokerage firms such as TD Ameritrade, which offer CME Bitcoin futures trading as part of their product suite, may set margin rates above the basic rates set by the CME. Because Bitcoin is a risky and volatile asset, regulated exchanges typically require higher margins than other assets. Some cryptocurrency exchanges, such as Binance, allow you to use cryptocurrencies as a margin. For example, you can use stablecoins such as Tether or Bitcoin as a margin for your trades on Binance.
The value of the contract varies depending on the price of the underlying asset. The Bitcoin reference rate is used by the CME to determine the price of Bitcoins. It is a weighted average of the price of a Bitcoin obtained from several exchanges and is calculated daily from 2:59 p.m. to 3 p.m.
Depending on Bitcoin price fluctuations, an investor can either hold the futures contracts or sell them to another party. When their contracts expire, the investor has the option to either roll them over to new contracts or let them expire and receive the amount of money owed. Some contracts, such as those in BACT and ErisX, are physically entered into. This means that the investor will receive the final delivery of the commodity, in this case Bitcoin, when it expires. In 2021, the CME introduced trading in micro Bitcoin futures. The MBT contract size is 1/10 of the Bitcoin or 1/50 of a larger BTC futures contract. Thus, if the Bitcoin reference rate is set at $20,000, the notional value of one Bitcoin reference rate is $400. More than 3,500 accounts traded micro Bitcoin futures after the initial launch.
Despite the volume growth, Bitcoin futures trading is still in its infancy in terms of market dynamics and constituents. Thus, it differs from trading futures on other asset types.
Bitcoin futures trading resembles cryptocurrency spot markets in that its ecosystem lacks the deep pool of liquidity or a sufficient number of participants that are present for other commodities. Consequently, trading volumes can be low and price swings can be high, especially during volatile fluctuations in the price of the cryptocurrency. Trading futures on other commodities can provide indicators or predict prices in the spot market in advance. However, Bitcoin futures either follow spot market prices or trade at a significant premium or discount. The legal and regulatory framework for Bitcoin futures trading is still unclear. Bitcoin futures trading offered on exchanges located outside the US is not within the purview of agencies located in the country. In such situations, there is the potential for profit through regulatory arbitrage, but they can also lead to exponential risk. The price of Bitcoin futures depends on the price of the volatile underlying asset. While there is a theoretical formula for calculating the price of Bitcoin futures, several other factors play a role in a real-world scenario. Investors' perception of the volatility of the asset is one of them. The big news is another. With its huge price swings and bubbles, Bitcoin already has a reputation among investors for price volatility. And there is no shortage of comments about the cryptocurrency, which was originally designed to be a medium for daily transactions, but has yet to deliver on that promise. All this means that Bitcoin futures are not an effective safeguard against the volatility of their underlying assets.
Thank you a lot for watching this video, but you can also check our channel for other videos.